Welcome everyone, and again, thank you for joining KBRA's webinar on loan quality performance for community and regional banks. My name is Jason Szelc. I'm a Senior Director in the Financial Institutions Group for KBRA. As Caitlin referenced, the QR code on page 2 that will take you to all bank-related research. I will also point out that the QR code that is on the top right of the slide, starting on page 5, will take you directly to the research piece we are referencing today, which is U.S. community and regional bank loan portfolio evolution and performance, which we published on August 29th. You can also find the research piece by going to kbra.com under sectors, finding financial institutions, and selecting publications. Of note, on the last page of the research report are links to both our 2Q23 Bank Compendium report, as well as the webinar, which provides a summary of results along with an outlook on the net interest margin and funding for the industry. I'm joined today by Shannon Servaes, a Managing Director in our Financial Institutions Group, Scott Durant, a Senior Director, and Jim Zhu, an Associate. Today, we'll be going through a series of slides covering key points from the research piece, with the discussion including questions presented by myself to Shannon on each topic. We will address as many questions as we can throughout the session. We will also allow for roughly 15 minutes at the end of the presentation for any additional questions related to today's topic. If you should not get your questions answered, the contact information for each of our speakers is included at the end of the research piece, and I would encourage you to reach out to us directly so that we may get those questions answered for you. Before we get started, I wanted to properly define our data used for this research. All data used is publicly available with no proprietary data included. We focused on regulatory data, namely call reports, with our time frame ranging from 2002 to 2Q23. This time frame was chosen in order to capture the last 2 credit cycles with the availability of more granular data beginning in 2002. We chose to use a customized peer group of banks with reported total assets ranging from 5 billion to 50 billion. As of 2Q23, that encompassed 224 banks. Of note, KBRA had ratings on about half of the customized peer group, though we do have ratings for banks outside the peer group. With that, we will start on slide 5 with the big picture and our point of perspective. Shannon?
Thank you, Jason. And good day, everyone, and thanks for taking the time to participate in the webinar. Just by way of background before I launch in, my background, I started off as a bank examiner with the FDIC, and then after grad school, I spent most of my career on the buy side in corporate bonds, including financial institutions, of course. And then I've been at KBRA for 5 years, and at KBRA, I cover banks, domestic and offshore, but I'm also responsible for broker-dealers, securities firms, and then quite a few non-bank residential mortgage companies. I think just to accentuate a few points that Jason made, all of the data that we do have here today is publicly available. It's bank level data, so it's coming from the call report filings. And then the rest of the data, whether interest rates or economic, is also from publicly available data. And I also wanted to just make sure that it's noted in terms of the peer group. It is 5 billion to 50 billion, and that peer group has obviously changed over the past 20 years, but we think it's robust. And one of the reasons we selected it is because, as Jason said, we rate about half of the banks in the peer group. So I think that gives us kind of keen insight into the behavior and the performance of these institutions or banks, not just in recent quarters, but going back a decade or more. So with all that said, if we take a look at the first slide there on page 5 of the presentation, I believe these 3 charts really sum up why we're here today. We're looking at the loan portfolios of these banks from top to bottom and how it's changed over time. And we'll have a slide later in the presentation that graphically illustrates that. But these three slides basically show that, since the global financial crisis, at least 2007-8, there's been pretty steady and stable economic growth, notwithstanding the dire effects of the COVID situation in 2020. But most important in my judgment is the interest rate level. Since the financial crisis, interest rates have been substantially lower than they were in the prior period leading up to the financial crisis, and certainly during the cyclical recession in 2001. And I think this has a significant impact, on banks' balance sheets, banks' growth and earnings. I think it's fair to say that low interest rates help asset values. Higher asset values generate lending activity. And you could even say when there is an underwriting mistake in the loan portfolio, it can usually help camouflage that. In addition, it's also beneficial for debt service burdens. But as you can see from the Fed funds chart and the 10-year chart, the two charts on the left, the rate environment has changed. And so, for these reasons, those three charts, I think, at KBRA, the bank team has the antenna up very high, in trying to anticipate what's going to happen with the loan portfolios, given the interest rate environment. The one thing I would say, how we think about this in some ways is if banks themselves are having challenges with funding, both access and cost, it's logical to conclude that private companies, corporations, industrial corporations, and other companies are probably going to have the same challenges. So we would expect there to be some loan problems develop over the ensuing quarters, even if the economic growth stays positive. So Jason, if you could go to the next slide, it'd be great. So just wanted to real quickly summarize, some of the objectives of the report. Some of this is, I guess you would characterize as a history lesson that we're going to get into. I think it's beneficial, instructive to look at how the loan portfolio of these banks, this peer group of 224 banks roughly, has changed over time, because there's definitely been some change, and that's important of how we think about the future. We also wanted to just touch on some of the regulatory policies and guidance connected to lending. It's primarily in the area of real estate, including commercial real estate. But I think it's important because my former employer, the FDIC, has the benefit of hindsight to see what's happened in various credit cycles, going back to the 1980s, for example, in Texas, and then in the downturn in the early 90s in Southern California due to defense spending cutbacks, all the way up through the global financial crisis. We're not going to go through these in too much granular detail, but we have provided later in the presentation some links to various things. And it's just the data, the information provides a plethora of examples in terms of what underwriting loan standards that should look like, appraisal guidelines, concentration limits, loan to value limits, all these different things. And so at KBRA, we always have these, top of mind. And I think it's a good foundation, not to say that it's perfect, but I think it's a good foundation for any analyst. A couple other things in terms of the objective. Multifamily lending, as we'll show and momentarily, has grown significantly over the 20-year time horizon, with much of that growth coming in the last 5 years. Multifamily has been a strong performer for banks in terms of credit quality and then growth. And so at this point, we thought it would be beneficial to offer a little deeper insight into that category, which we'll do. And then a little bit more of a history lesson, I guess. We're going to highlight, how the historical loan losses developed in the 2001 cyclical downturn, as well as the GFC, the global financial crisis. And then we'll show what we characterize as structural earnings, the coverage of those losses, noting that even in the financial crisis for the peer group, there was enough structural earnings to cover the loan losses. And by the way, we define structural earnings as earnings before provision expense and income tax expense. And then there at the end, when we conclude, we have a stylized scenario analysis that does two primary things. It stresses the net interest margin lower for these banks in a significant way, which is consistent with the trend that we're seeing through 2Q23. And then we use the peak loss rate in the 2001-2003 cyclical downturn, because we think, although it won't match it perfectly, it's more similar to what might occur than the GFC. So as we move on to the body of the presentation, the next page, this gives you it provides you with a graphical depiction of how the loan portfolio of these banks change. Again, these categories in the bar chart are all regulatory driven categories, taken right from the call reports and the Uniform Bank Performance Reports. And so there's two notable things. If you look at consumer loans, which is at the top, a light green right below the red bar, and then go all the way down to the bottom and look at the deepest blue bar, and then take those together, you can kind of see that, consumer lending, the light green at the top, and then the dark blue residential has shrunk or declined over time. And that's really been replaced by three things: multifamily lending, other commercial real estate, and then owner occupied. And we provided a table adjacent to the chart that shows the CAGR, or the compound annual growth rate, over the past 20 years. And you can see multifamily has led the way. Other CRE, which is really non-owner occupied commercial real estate. And so there's been significant changes over this time horizon. We would characterize the decline in consumer lending, including residential lending, post the global financial crisis, again around 2008, as primarily attributed to technological advances and increased competition from non-banks, both in residential and consumer lending. I think it's fair to say that consumer lending is driven by the law of large numbers in some context. So the companies that are technologically advanced, or just larger financial institutions buy footing, they're going to be able to compete more favorably due to economies of scale. I think that's the primary reasons. Those are the two primary reasons why these smaller banks of 5 to 50 billion have ceded some market share on the consumer side. And then to make up for it, as the table shows, the loan category table with the CAGR growth, it's primarily been in multifamily, other commercial real estate, and then owner occupied CRE.
Shannon, a couple of questions to add for this at this time. First, the time horizon spans 20 years, and there's been a lot of change since before and after the GFC. What would you say are some of the key regulatory and market factors that have evolved during this period?
Well, one, thanks for the question, Jason. One, I would say in terms of the regulatory side, there are loan concentration limits that were put in place, I believe in 2006, that primarily are connected to commercial real estate. So construction and development, which is C and D in the chart in the table. And then also for commercial real estate loans, which would be all commercial real estate, including multifamily, but excluding owner occupied CRE. So I think over time, the banks have managed to those concentration standards pretty rigorously. And I think everybody can kind of understand that concentrations, while not necessarily always negative, are something to be aware of, because something can go wrong that's completely unintended. a functional obsolescence or, a competitive change. 2010, I believe nobody thought Amazon would disintermediate the retail space like it has. So, concentrations are a significant thing. So I think over time, subsequent to 2006 and going forward, that's been a big change. And the banks, the banks that we evaluate, that we rate, are pretty disciplined around that. Yeah, I think some of the other changes also connected to technology and market information, in terms of being able to underwrite loans in a more granular detail. It's not just at the MSA level, it can be at the zip code level, the neighborhood level, in terms of traffic patterns and all these different things, if it's, for a retail property. So I think, the information flow is just much more dynamic than it was 20 years ago. So I'd say those are two things.
Great, thank you. And one final question before moving on here. How would you characterize the riskiness of the average bank's loan portfolio today versus, say, 10 or 20 years ago?
Yeah, I mean, if you can set aside the global financial crisis, which, I believe was an extraordinary event, driven by, underwriting standards, or propelled by underwriting standards that, are clearly not present today and unlikely to be present anytime soon. I would say, the portfolios are generally the same. With more consumer loans, you have obviously a more diversified repayment base, because the repayment sources are essentially the borrower's income. And, he or she is going to be working in a lot of different sectors of the economy, generally, a reflection of the aggregate economy, unless there's a concentration in a certain geographical area, whether it's technology or manufacturing, for example. So that's a benefit, as opposed to, a commercial real estate loan where the repayment source may be, and it usually is, a little bit less diversified. So I'd say the bottom line is not a great deal of change, but I'd say on average, probably a little bit more concentrated and probably a little bit more higher risk.
We'll move on to the next page. Thanks, Shannon.
Yep. Real quickly, for background information, for those that may not know this, and it's germane to the presentation, the regulatory data that we're using, again, for all the bank disclosures is for the loan reporting category, it's summarized in this table. And the reason we wanted to put this in here is because when you look at non-owner occupied commercial real estate, for example, there on the left side of the table, the fourth one down, there's no property sector disclosures at the regulatory level. So, for example, there's no disclosures on what % of that consists of office properties, retail properties, lodging, hospitality, industrial, etc. And so that is while the regulatory data has improved over time, and I would characterize it as robust, that is one limitation. And so there's some other things, like in commercial and industrial, there's no sector representation there. We'll touch on in a minute how we think that looks, what that looks like. But I think from just a big picture perspective, and to make sure everything's in order, that's something to be aware of.
So we've got one question here for you, Shannon. While the regulatory data is good and has improved, it seems that it remains pretty broad. If this is true, how does KBRA evaluate loan portfolios that may be focused on, certain types, specific geographic regions, and or parts of the country with varying economic conditions?
Yeah, good question from someone out there. I mean, the simple answer, but it's the answer is we dig in bottoms up. So, when we were looking at the loan portfolio of any given bank, we look at the pie chart, if you will, of, the categories, the loan categories, basically using what's in the table here. and look for, what's sizable, the size of the pie slices, if you will. And then from there, we that leads us to where we want to go, in effect, or where we need to go, I guess I should say. So for example, on the commercial real estate, the non-owner occupied commercial real estate segment, we look at, what constitutes, that portfolio, that sub portfolio by property type. And then once we get to the property type, that's when we begin, the dialogue with management in terms of the disclosures they provide us, to understand, the underwriting parameters, the geographical mix, the nature of the borrowers, large borrowers, middle-sized borrowers, etc. The size of the loans, the growth of that portfolio, the growth of the subsegments. Obviously, we look at debt service coverage ratios, loan to value ratios, the other things. And then we try to be nuanced and thoughtful around it. So if I could just switch to the multifamily, one of the things we typically touch on is, all else equal, what would be the break-even rate, occupancy rate, to keep the debt service coverage ratio at 1-to-1. So if, the current occupancy on an apartment loan is 95%, for example, what would be the break-even, keeping everything else the same on occupancy, so the borrower could meet the debt service burden. And generally, just by way of, kind of giving you some insight, it's usually around 85%, at the current run rate. That's not scientific, but that's normally what we get back when we run the numbers with the bank management team. Obviously, the landlord has other things that he or she can do in response, by lowering the rent or whatever to keep the occupancy up. But I'd say that's a flavor of what we do, Jason. So not going to spend a lot of time here. We provided this because, again, as I said at the outset, there is just a lot of information, and with respect to, how the bank regulators, give banks guidance on loan underwriting, commercial real estate, and otherwise. In the research piece that Jason mentioned at the outset, we spend more time there. I think the high level takeaway, from the research piece is twofold. One, the bank regulators, not just the FDIC, but all the bank regulators, have a kind of a rule of thumb, if you will, that construction and development loans should be kind of capped at 100% of total risk-based capital. And then for commercial real estate loans, including construction and including multifamily, but excluding owner-occupied commercial real estate, it should be capped at 300% or 3 times total risk-based capital. That's, as I said earlier, that's been in place since 2006, but I think that's important, especially given the chart we showed on the migration of the loan portfolio over the past 20 years. Then the other thing that's also in the research piece that's not, displayed here is there are loan to value guidelines that the regulators have, published. And that's interesting because when we work with the banks, I would say there is very, very limited exceptions where we see a bank lending beyond those thresholds, either at origination of a loan or renewal of a loan. So I think that's a positive situation. Not to say the value can't change and won't change, but given those guidelines, which are relatively conservative, we just don't see banks breaching those thresholds. But anyway, the link there, I think, for anybody that doesn't know about these sources, it would be worthwhile to take a look at them.
We have a couple attendee questions here that we wanted to address. The first one, and this relates to the concentration guidelines. Does the FDIC still consider CRE exposure greater than 300% of Tier 1 capital the inflection point for probable failure, or has the exposure figure decreased to 200%?
So there's been a number of updates to these guidelines, over the years since 2006, ranging from appraisal practices to underwriting standards to working with borrowers, et cetera. I don't, so to answer the question succinctly, I don't know that there's been any change off the 300% level, and I don't know the science behind 300%. I'm sure there is. I was long gone from the FDIC in 2006. I think it's a good rule of thumb and a guideline. Certainly some banks are over that. Most are not, however. But I don't know that there's been a change or discussion down to 200%. It's something to, that we can look into. But I think the 100, 300 have been out for a long time. I guess that's what I know, Jason, at this point.
Great. And the second question was, how much discretion do regional banks have to delay classifying an outstanding loan as a non-performing or problem loan? Is there a time limit?
So I think what we have from the regulatory, if you look at it from a regulatory perspective and germane to the slide, there's pretty well developed policy statements around certain segments of the loan portfolio, then call report instructions for reporting, loans on non-accrual, for example. So just to summarize it real quickly, I kind of think about it in terms of 180 days past due, 120 days past due, and then 90 days past due. For 180 days past due, obviously the loan's delinquent, but for open-ended consumer loans, so think of home equity credit cards, at 180 days, those are required to be charged off. That policy has been around since 1980, I believe, a long time. In the same side, in effect, on 120 days past due, any consumer closed-end loan has to be charged off. So, the most prominent example there might be an auto loan. So those are fixed, and banks have been following those for years. With respect to residential loans, it obviously goes past due at 30 days, but at 90 days, it's per the call report instructions, the bank is required to put it on non-accrual status unless the loan is both well secured and in process of collection. So, relatively low loan to value and is going through the foreclosure process. With respect to all other commercial loans, so commercial, industrial, and commercial real estate loans, there's more discretion there. The repayment terms vary. They're usually not monthly. They can be monthly, sometimes quarterly, sometimes annually, sometimes interest only, sometimes P&I, etc. So there's clearly more discretion there because there needs to be. But generally, the rule there is at 90 days, the loan needs to be put on non-accrual. And the payments accounted for as a cash basis. Historically, going back to my days at the FDIC and then subsequent, we generally find banks are more proactive on a commercial loan, either real estate or industrial, before 90 days. They're proactive to put it on non-accrual early in the process, sometimes before it even becomes delinquent. The one other thing I might add, Jason, is on the internal watch list, which virtually all banks have these days, which is kind of their own internal classification system, how they, risk rate the portfolio. There's two factors that drive that. If the bank examiners classify a loan on a normal examination, the bank generally will match that classification. So if the examiners classify a particular loan substandard, the banks usually classify it the same. But beyond that, it's kind of case by case on how, a bank would disclose, or how a bank would classify or categorize, a loan, whether it's, all is well, or there's some payment problems or collateral issues developing. And it's worth pointing out that not all banks disclose the internal watch list, but some do. So we thought it would be worthwhile to mention it.
Excellent. Let's keep moving. We'll go to the next slide here, where commercial real estate and multifamily peer group exposure.
Yeah, so real quickly here, I think we touched on this in effect, but the first chart of CRE, commercial real estate, again, excluding owner-occupied commercial real estate, and then construction and development. You can see based on the regulatory guidance of a 100% for C and D and 300% for C and D and the rest of the CRE bucket, for our peer group, they've consistently maintained their exposures below the regulatory concentration guidance. And so I think this is one of the things you asked earlier, Jason, what's been beneficial, how are things changed over time? And so you can see when these standards were developed in 2006, that the concentration's been pretty well managed as a whole. On the right, the last two charts, the middle one and the one on the further right, if you look at the top quartile, there are some banks that clearly are above, the 100% in the middle chart, the 100% and 300% levels, the top quartile. And so these banks, certainly have more scrutiny by KBRA, the ones that we rate. I would say that there are usually some mitigating circumstances here, one of which is, these institutions, tend to be more specialty lenders and have a long track record of developing, the expertise in this area and have been through at least one, but probably multiple underwriting cycles. But for the most part, on the whole, we think the first chart on the left is a more realistic reflection, if you will, of the average bank.
Do have a question here I wanted to ask related to the concentrations. For the top quartile of banks that have noticeably higher exposure, are there any mitigants or is their risk tolerance simply higher?
So there's a couple things. One I mentioned is generally these institutions are more specialized and have have developed a track record over time. So that's the first thing. I think the second thing is this is not consistent, but in terms of the regulatory capital ratios, so say like the CET1 ratio, which has common equity essentially in the numerator and risk-weighted assets, so risk-weighted assets in the denominator. Generally, we see banks with higher capital levels. To be fair, they need to have higher capital levels. Otherwise, the concentration limits here will get too high because the concentration does include an element of capital, the total risk-based capital amount in there. So I'd say those are two things. But look, there's no way of getting away from it. If you've got a higher level of concentrated risk, even if it's spread out geographically, multiple borrowers, you're still exposed to the kind of some of the same factors. So for example, on construction and development loans, the exposure would be from market risk or refinance risk, for example, right? There's just really no way to get away from that. If you're making a construction loan and you want to perm finance it with a life insurance company or some other long-term lender and the market's volatile, you may have to mini permit, for example, which is to say hold it on your balance sheet when you originally thought that after 2 years after the property was built, it would be permanently financed at another institution.
One more question. I know we need to keep moving here, but one more question that we have related to the concentration. Are regulators usually open to letting a bank exceed the 300% level if a bank has a good track record of managing its credit risk?
Yeah, I mean, the only insight that we have to that is the discussions during our due diligence process. Obviously the bank examination reports are confidential, but that's the only insight we have into it. I think the best way to characterize that is probably the obvious way. When our discussions, my discussion certainly is the antenna by the regulators is higher. There's just more scrutiny around when you exceed those limits. I mean, I think if you're above the limit, in some level, it's probably not that big of an issue. Kind of what I've gleaned from discussions, but when you get well above it, I think the bank is opens itself, not in a negative way, but opens itself to more rigorous examination around that portfolio.
And Shannon, if I can jump in and add, one other salient point here. Based on discussions that we've had with bank management teams over the years, the regulators, I think maybe you can opine on this. The regulators are well aware of level and trend. So there are certainly conversations that develop should a bank continue to approach that 300 threshold and then eventually cross it, specifically around the requirements for those enhanced regulatory reviews. Certainly they require additional comfort and diligence in underwriting, monitoring of the portfolio, et cetera. Do you think that's fair?
Yeah, I think that's a fair representation, Scott.
All right, let's move on to the next slide here.
So we just wanted to spend a little bit more time on the multifamily portfolio since it's been the biggest growth factor by loan type over the 20-year time horizon, with much of the growth really taking off in 2018 and then picking up during the coronavirus and subsequent years. The research report goes through various charts that are underpin this graphic that you're looking at here in terms of multifamily performance factors or indicators. And I would encourage you to read that. I think it's enlightening, bias noted. But I think the situation is that multifamily has been a strong performer for banks for a long time. And the reason it has been is there's just been a lot of demand for multifamily. Household formation kind of took off post the global financial crisis. There at one point there was a pretty significant city in-migration trend, that benefits multifamily. The economy was stable. Low interest rates were low. All these positive things, we're driving, the multifamily, sector. Just some other factors were, the GSEs, Fannie and Freddie, are, pretty heavily involved. So they provide liquidity to the space in terms of capital markets and lending, another positive. And then over time, especially the last 3 or 4 years, housing, developed a shortage, which further propelled the demand. And then in the last year or two, since the Fed moved from ZIRP or zero interest rate policy, the cost of housing has really gone up. We looked at the cost of the principal and interest on a monthly payment for the median priced home. From the year in 2019 to 2Q23, it's gone up, by about 3 times because home prices have gone up so much and the cost of borrowing has gone up so much. And looking at that relative to the increase in rental rates, it's more than 3 times, the past 18 months or so. So I think there's been a lot of things that have propelled the space, and there's been a lot of lending activity with very, very few problems. But at this point in time, primarily due to interest rates and inflation, I believe, I think we may be in a situation where there could be some consolidation in the space and maybe some mild turbulence. And so I think this graphic shows on the left-hand side and the red colors or the red tones, some of the issues. And in the research report, we graphically illustrate the supply. The supply has really picked up 2021, 2022, and there's set to be a lot of deliveries this year and next year. In addition to that, around interest rates, interest rates are taking its toll, not necessarily on the borrower, although that's probably going to happen, but, we think on, just the renter. And in addition, the renter is facing elevated expenses from inflation. We've listed one here, property insurance. just as one example, that's gone up, maybe by 20% year over year. And then, of course, there's, the pending resumption of the student loan repayments. And then when you think about it from a finance perspective, the borrower will have to pay a higher interest expense at some point when the loan matures. Most of these apartment loans are on 25-year AMs with a 5-year balloon. So, in 5 years, when the loan, is up for renewal, the interest rate is going to be quite a bit higher. And then one thing we note is the cap rate spreads. The cap rates on, we think about cap rates kind of a lagging indicator, but cap rates have been tight on multifamily for, or low, I should say, for a long time. So the cap rates, obviously the risk-free rate plus the term risk premium, but they've been low for a long time for good reason. There's just been a lot of demand, not many issues, and so solid returns to both the debt and equity investors in apartments or multifamily. We think that's, on the precipice of changing because, with a 10-year at around 430 and cap rates for most of the last decade having a 4 handle on it, that's ultimately going to change. And the way that'll probably change is, the cap rate's going to have to widen out relative to the 10-year. And the cap rate spread is basically the cap rate on whatever type of property you're talking about, less the 10-year. So I think, to kind of sum it up on the multifamily, we're watching that sector growth. It's been a long, closely. There's been a long period of growth, been very, very good, stable performance. But there's a kind of a confluence of factors that are confronting lenders in this space that they're going to have to deal with over the ensuing quarters. And, we're taking a very close look at that. I already mentioned we look at the break-even occupancy. We certainly look at the loans by, apartment loans or multifamily loans by vintage. That is by year. I think that's crucial because the underwriting standards, the competitive dynamics change year by year. We're looking at, we look at some of the GSE, Fannie and Freddie data, and look at the new apartment supply, where they're coming in terms of zip codes in major cities or wherever the bank competes. Zip codes, neighborhoods that we can differentiate between whether it's high rise or garden variety style apartments. So I think the antenna is up, and I think it's for good reason. We're certainly not predicting, heavy turbulence here. We just think there's going to be some mild turbulence when there's been a long period of virtually no turbulence.
And I know we need to keep moving, but before we move to the next slide, there was one question I wanted to get to. And although not related to multifamily, the research report provides some thoughts and conclusions on loans secured by office properties, which has been widely viewed as a potential problem area for banks. If you could quickly, can you summarize some of those thoughts for us here?
Yeah, the research report does address some of the key issues confronting office properties. So I think from how we would look at it is the banks in this peer group, which are smaller, are constrained by legal lending limit requirements, which is basically the largest single loan you can make to a borrower or a group of related borrowers can be no larger than 15% of your capital. So what this really means is a lot of the banks don't participate in office loans. Certainly we have some banks that do. And when they do, it's generally going to be suburban offices rather than central business district or CBD loans. And so that's kind of the big backdrop. When you look at exposure to office loans, it really comes from 4 different areas. One, direct lending in the commercial real estate portfolio. And I would say we have banks with 0 exposure all the way to up to, call it 15% of the total loan portfolio. But the average bank is going to be kind of mid to high single digits in terms of office loans to total loans. Then there's some C&I exposure. This is generally indirect. This is C&I loans made to property managers, real estate rental, leasing companies, not where the collateral's the real estate, but the business is involved in real estate in some way. That's pretty significant exposure. for some banks in the C&I portfolio, but keep in mind from that very first chart, we had C&I is only about 20% of the total loan portfolio for the average bank in this group. So it can be kind of high. It's indirect exposure, but nonetheless, it's, it's exposure. And then the two other categories, there's some lending to REITs and non-depository institutions that are exposed to housing or exposed to real estate, but we believe that's that's mostly housing. So for example, warehouse lines to non-bank residential mortgage companies that are financing, Freddie, Fannie, and Ginnie Mae loan production, for 30 days before it becomes securitized. And then the final thing is on CMBS exposure, obviously not in the loan portfolio. It's in securitized form or securities form. Some of our banks do have exposure for this peer group. CMBS exposure is about 25% of capital. So, significant, but relatively low compared to direct loan exposure. The thing I would say about that real quickly, Jason, if you think about the typical CMBS cap structure or tranching, 75% of the cap structure is AAA, AA, single A, with the rest of it going to be, triple B minus or triple B and then lower. So the cushion's 25% if you're, at the invested at the higher tranches, and we believe most of our banks buy single A or better. And so if you look across a lot of CMBS deals, it looks like office exposure is about 25% at any given deal. And so if you assume like tomorrow we wake up and there's 100% default rate, so that would be, a 25% default rate on any given CMBS deal. And let's just assume that the loss given default's 50%. So that CMBS deal, has to take a write down of 12.5% of the par amount of the security. We think the banks are pretty well cushioned, from a CMBS perspective. Now it leaves aside the rest of the structure that, has retail, multifamily, industrial exposure. But I think for the most part, CMBS should hold up pretty well for these banks.
All right, so we've got about just over 10 minutes left. We got two more slides we want to go through. We'll start here with structural earnings, coverage of loan losses, historical perspective.
Yeah, this one can be quick. We just wanted to give a flavor for historically when there's been episodes of high loan losses, which would be the dark blue bar. You can see it came up, early in the 2000s from the 2001 recession, and then, spiked pretty high in the global financial crisis. We wanted to capture those. I should make a note that the blue bar, the navy bar, that's net charge off to average assets. Normally it's depicted or displayed relative to average loans, but to keep everything apples on apples, average assets, we rescaled it to average assets. So the key takeaway here is even in those high level of loss periods, the pre-tax, pre-provision earnings or structural earnings has been sufficient to cover those charge-offs through time. It's definitely declined and narrowed in certain periods in the 2000 to 2010 era in particular, maybe up to 2011. But that's the good news. These banks have had a lot of structural earnings, or sufficient structural earnings, I should say, to cover, these losses, even in periods of very high losses. So, this is the good news of the presentation, I believe. But, it's in the past, not in the future.
And let's go ahead and move on to our final slide. Stylized scenario analysis on NIM compression and loan losses scaled to the 2001 cyclical recession peak.
Yeah, so this is the future part, right? We just looked at the history for the last, 20 years or so. What we wanted to do here is, to conclude the research report is just, I think it's conventional wisdom at this point that, generally banks' earnings are going to be under pressure for a little bit of time here, primarily due to net interest margin compression. which is really attributable to pretty rapidly rising deposit and other funding costs. So, the $1 million question, I guess, is if earnings are going to go lower here to some level and we revisit, higher charge-off levels, which we really haven't had for a decade, what might the coverage look like? Which is to say, do the banks, or will these banks in this peer group, these 224 banks, will they have enough structural earnings to cover the losses? And so what we really did here is we just took the net interest margin down by 100 basis points on a straight line basis, so 25 basis points per quarter over the next 4 quarters, and left non-interest income and non-interest expense or overhead expense unchanged, and then compiled that aggregate amount of structural earnings, if you will, so excluding provision expense and taxes. And then we took what the not the cumulative, but the peak loss rate was in the 2001 downturn, which was in 2003, of about 80 basis points. And so when you look at the illustrative stress scenario in 2Q23, the net interest margins for these banks is 352, and then the pre-tax, pre-provision or structural return on assets or average assets is 150 basis points. If you look at our stress scenario of taking the margin down 100% and using the charge-off rate, the net charge-off rate in 2002, again scaled to average assets, the coverage would be down to 23 basis points. So a lot lower under pretty draconian net interest margin assumption, but still positive. And so I think this, while we didn't model the net interest margin out on both sides of the balance sheet, that is earning assets and costing liabilities, I think this provides a pretty good representation for a period when loan losses were elevated, coming out of the tech bubble burst and the CapEx driven recession of 2001, and with a net interest margin that we could go a lot higher. Now, we're not for sure where the net interest margin is going to go. We have our own ideas, but it's hard to predict in some ways because a lot of it's behavioral driven on the part of depositors. But one thing we know is the gap between where the current level of interest-bearing deposits are for this peer group, which is around 2%, relative to the Fed funds rate, which is around 5.30, there's still a big gap. And if you go back to prior periods, that gap was a lot lower. So we definitely, are baking in base case that funding costs are going to continue to go up here for the next few quarters, even if the Fed were to be on pause for a while.
So we have one question on that, Shannon. And so realizing that you're accounting for that additional funding cost pressure, the prospect of lower structural earnings due to the, the potential additional, even substantial NIM compression. But shouldn't there the ability to increase the rates on loans, for example, somewhat offset some of that?
Yeah, that's an excellent question, and certainly that's occurring. As loans mature or are up for renewal, they're repriced to market standard. Most of the C&I portfolio, which is 20% of total loans, is priced off of LIBOR or now SOFR, so it reprices pretty immediately. But I think the dilemma we're facing as a team at KBRA, and something we're actively dialoguing with senior management at these banks about, is, deposits, pricing can be relatively inelastic, right? In some cases, it can even go below zero. But, the market, if a T-bill rate's at 5.5%, and that's the opportunity cost for a depositor, the depositor has a decision whether they ask the bank to pay them 5.5% or they invest in the T-bill. On the borrowing side, the case is not as clear, because at some point there's a limit on what the borrower can tolerate in terms of interest rate. And so if we circle back all the way to the beginning of the presentation, we think that's why we put 2 interest rate charts in there and only 1 economic chart. We just think the interest rates is going to have an outsized impact this time because, for the last decade, rates have been pretty low. And I think it's an open question whether there's some business models out there, not banks, but, just regular companies, business models that, were built, for low rates or operate better in low rates. And so I think, again, the question of how much, how high can some of these borrowers take on interest rates on their loan rate, their loan coupon, is an open question. But I surmise, that at some point, you won't be able to raise rates a whole lot higher for some borrowers, especially the borrowers that don't have a lot of operating leverage, without kind of pushing them over, so to speak, on the debt service burden.
Great. So that takes us to the end of our presentation. We did have one additional question in here I wanted to address. Someone asked, could we please talk about differences in the typical risks for community banks versus regional banks?
Yeah, so I think there's two big things that come to mind. So this is just me. I'm agnostic on the size of the bank. I think the size of the bank matters and it's different, but I don't know that a bigger bank is less risky or more risky than a smaller bank. But in terms of geographical representation, we do have to be mindful if a bank has a smaller footprint, if they're susceptible to certain industries or economic factors that are more concentrated and not reflective of the U.S. aggregate economy. So generally on community banks, they're going to be a little less geographically diversified. The other thing I would say on the larger regional banks that we rate at KBRA is the loan sizes are larger. I think that cuts two ways. The larger loan sizes allow for some diversification within the portfolio, no doubt. But I think those loans are generally more competitive. There's more, lending, competitiveness from larger banks, larger regional banks, in addition to some of the community banks that either participate directly or participate through the syndicated loan market or just pure participations purchased. So I think those are two big differences. But at the end of the day, in terms of just the loan portfolio, excluding the rest of the banking franchise, I think it comes down to those two factors as being the predominant things that we look at or evaluate.
Great. And there was one last question, and a question about the list of banks represented in the data. Again, just wanted to highlight that our customized peer group is banks with assets between 5 billion and 50 billion, and that list of banks could change from year to year depending on banks that might have grown into the customized peer group or grown out of that customized peer group. And in some cases, of course, during the global financial crisis, some cases failing and then obviously being removed from the customized peer group at that point. So that peer group did change throughout the time period. I don't know if anybody else has any further comments on that, but we are at our time.
I think, Jason, if we have any additional questions, I think we have time to address them. I don't know that there are any, but.
Yep, that was the last of the questions that we had. So I think that's the end of our presentation. Thank you, everybody.
Jason, I just conclude by thanking everybody for their attendance and participation. If there's any subsequent questions that develop, our contact information is available in the research report. I'd encourage you to reach out to any one of us or all of us. We'd be happy to entertain any questions, drill a little bit deeper, whether it's the regulatory data, the loan portfolio dynamics. And so, yeah, be happy to address anything subsequently.